Hi guys, welcome back to my channel. Kelvin here. So, just last week, Temasek reported that their portfolio size grew to $400 billion for the first time, which is huge. Huge enough to make my few $1,000 portfolio look like a joke. But the more impressive fact is that they managed to grow their portfolio in 2022, when the market was crashing left and right, where our portfolio was CBA red, like it was Chinese New Year or something. So, in this video, I want to gabble a bit and check out how is Temasek investing, and probably learn some investing skills from them. Because after all, they are one of the real pros in investing. But before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you a kitten playing. Alright, let's start right now. Okay, just in case you don't know who this Temasek guy is, many people treat Temasek as a sovereign wealth fund. But Temasek be like, well yes, but no. Temasek regards itself as an investment holding company, where it still pays taxes and distributes dividends. So it's a bit like Warren Buffett's Berkshire Hathaway, where it buys and owns companies. But the main difference is that Temasek is 100% owned by Singapore. Their purpose statement is simple: so every generation prospers, or what I like to call, so every generation, what big. Now, you may be curious, where does Temasek get their money? Is it CPF? No. The first thing they immediately say is we do not manage Singapore CPF savings. Most of their money comes from divestments. Basically, they earn money by buying low and selling high, or sometimes buying high and selling low. They also earn from dividends and distributions, which is $9 billion this year. So if you do a rough math, the dividend yield is around 2%. Other smaller sources are like bonds and commercial paper, like the one they offered last year, bank borrowings, and additional investments by Ministry of Finance. So that's where the money comes from. As to where it goes, it's used to pay for stuff like bond interest, taxes, and the Singapore government can spend up to 50% of Temasek's returns. After seeing this, I was suspecting something. If Temasek reported that they earned so much money, there must be someone commenting why the government still wants to raise GST. And as it turns out, there really is someone commenting about it. Temasek earns so much, still want to increase GST? Okay, it's a fair question, but the answer is quite simple. Temasek returns is not enough law. The government has already mentioned that they were having budget deficits of more than $75 billion over the past 2 years, and have drawn down reserves by $53.7 billion. So they wanted to raise GST to rebuild their finances. That's how money flows in and out of Temasek. Okay, let's take a look at how Temasek performed over the past few years. This is an overview of their return. It's going up. So yes, they are doing their job well. However, you can see that the percentage returns are actually going down over time. If we look at since inception, they gave a 14% annualized return. Then it drops to 12% annualized over 40 years, 8% annualized over 20 years, and 6% over 1 year. Now, don't get me wrong, I'm not saying that they suck at investing. Instead, the reason is because Temasek is much bigger now. When you are bigger, your growth becomes slower. If you check Berkshire Hathaway's 10-year return, it has also been going down over time. However, that's something I'm quite curious about. How is Temasek performing compared to everyone else? It's just like after you scored 90 points in your math exam, your mom still wants to compare you with your neighbor Xiaoming. Luckily, Temasek has already done the job for us. Here, the blue line is Temasek's return. The pink line is Straits Times Index, which I will ignore because the performance sucks. So I'll just compare Temasek to MSCI World Index, which is basically the top companies from developed countries all around the world. At the start, Temasek was outperforming MSCI World Index by a bit. But in the past 10 years, Temasek has been underperforming. Now, even though this is MSCI World Index, I would expect the same results if we were to compare it with S&P 500, because a big part of MSCI World is in US. So, like I said, when you are bigger, it's hard to consistently give a high return. Next, let's take a look at the portfolio. The first thing that I noticed is that the portfolio is super diversified. If you look at their investments, the biggest holding is just 7% in DBS, followed by Singtel and Mapletree Investments. The remaining 82% are in a lot of other companies, from many different sectors like financials, transportation, industrials, and technology. Not only that, their portfolio is also diversified across many different countries. And the interesting thing is, they have been increasing their allocation overseas. In 2004, 52% of the investments was in Singapore, but now Singapore only takes up 27%. Okay, let me share 3 takeaways that I got from this. First, risk management. Temasek is managing money for Singapore, so obviously they need to have good risk management. They have something called an organizational risk management framework. One of the investment criteria is to focus on long-term performance, like all good investors should. So obviously, they can't trade cryptos or meme stocks and aim for 1000% return a day, which would have been awesome. Besides that, they need to maintain a resilient balance sheet, or in other words, they need to make sure even when the market is going down, they don't lose too much money. Because for us, if S&P 500 drops by 30%, we can be like, this is fine, and just wait for it to recover. But for Temasek, they cannot be like, this is fine, because if they end up losing too much money, then the government will end up not having enough money to use, and we have to increase GST again, which is bad. To manage their risk properly, Temasek diversifies their portfolio across many different companies, sectors, and countries. As a result, even though they lost money in some years, the loss is actually not that bad. Like in 2003, they lost 19%. Meanwhile, the market lost a lot more at 23%. Same for 2009, where they lost 30%, but the market lost a lot more at 38%. On average, they can still deliver an 8% 20 years annualized return. So diversification is important to reduce risk. And yes, I know with my portfolio being 80% Tesla, I'm the least qualified person to say that. But right now, I'm actually starting to diversify into other companies to reduce my risk. So that's that. Second, invest consistently. Everyone knows this. Time in the market beats timing the market. This is a chart of Temasek's investments and divestments. You can see that every year, it doesn't matter whether times are good or bad, they are still investing consistently. But here's one thing I want to mention, and I want to give Mr. Lu credit for this. He pointed out when the market is doing badly, Temasek has invested a larger amount than usual. For example, during the Great Financial Crisis, 2015 China market crash, 2018 market mini crash, and during the recent 2022 crash. The term for this is called Enhanced Dollar Cost Average, or EDCA. Basically, when times are good, you will reduce the amount that you invest. But when times are bad, you increase the amount that you invest. Researchers found that EDCA can actually outperform normal DCA most of the time. With that being said, I want to point out that EDCA is similar to timing the market, but you don't have to strictly follow the EDCA rule. How you do it is totally up to you, because after all, past returns doesn't guarantee future performance. The takeaway from Temasek's strategy is that you need to keep DCA as usual, or building up your war chest money. Then, if there's a downturn, that's when you deploy the money that you have saved. For example, during normal times, I would invest like 95% of my cash, while keeping the remaining 5% on the sidelines. Then, during a market crash, I would invest all the remaining amount. Third, investment thesis. Temasek investments are based on 4 trends that will shape how the world becomes in the future, like digitization, sustainable living, future of consumption, and longer lifespans. For each investment that Temasek makes, they always focus on intrinsic value and risk-adjusted return. Basically, they don't just be like, this stock has gone up 1000%, it must be a good stock. Instead, they come up with some thesis why it's a good stock. Then, they look at what's the risk of investing in it. For example, recently they invested in FTX, a crypto exchange. Even though some people be like, crypto is worthless one lah, or crypto will go to zero one lah. Temasek believes that blockchain is an important technology for the future, and this is a good opportunity to invest in it. Also, they won't just hoard their investment forever. If their thesis is no longer valid, or it turns out to be wrong, they will paper hands and sell. Here, you can see that Temasek is always divesting investments. A while ago, Chinese stocks was crashing super hard when the government was cracking down. Turns out, Temasek was investing in Chinese stock, and lost a bit of money. Due to that, they even earned a post on Wall Street Bets. Eventually, Temasek decided to cut the stake to reduce their risk until they have more certainty what will happen. So, this is also something that we can learn. Whatever you are investing in, you need to know why you bought the stock. And no, it's not because some YouTubers say so lor. For example, I bought Tesla because I feel that they would revolutionize the transportation, AI, and energy industry. But if one day it turns out that my thesis is wrong, then I would immediately sell the stock. So that's the 3 takeaways that I got from all this. With that being said, I want to mention about the sponsor of today's video, moomoo. Okay, you already know that moomoo can be used to buy and sell stocks. So I won't talk about that today. Instead, I want to show you a super useful feature that moomoo has, and that is the stock screener. In the app, if you go to market, tap on stock screener, you will be able to create your own stock screener. But moomoo already has some presets which you can check out. For example, there's the Warren Buffett criteria of picking value stocks. If I tap edit, go to conditions selected, I can see that the criteria are market cap needs to be huge enough, at least 6% annual profit growth rate, at least 30% gross margin, operating profit over earnings before tax at least 70%, and 10% return on equity. After that, you will get stocks that meet these criteria. Or maybe you want companies that can give high returns. You can choose the high profit and growth preset, which basically says that net margin, operating profit, net operating cash flow per share needs to be at least 30%. After filtering the stocks, you can do your research further to find the companies that best fit your investing style. So go check out the stock screener function. If you have not signed up to moomoo yet, you can sign up with my link down below, deposit 2.7k, or if you are a student, just 1k is enough, and receive 1 free stock and a $40 cash coupon. On top of that, from now to 31st July, if you invest $500 or more into any fund, you will receive $30 cashback and additional $70 for maintaining the position for 30 days. So if you are interested, you can sign up with my link down below. Anyway, that's all for today. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.